The Rebel Capitalist Show.
I heard an interview that you did the other day with another one of my favorite media outlets. Well, I don't like CNBC that much. I like Real Vision way better. And you were talking to Ed Harrison, who's great. And you were going over a concept of the Fed, or excuse me, the market calling the Fed's bluff, in the sense that the Fed is saying we're going to let inflation run hot. And the market, the bond market, is saying, nah, I don't think so. So can you go into that concept that you discussed with Ed?
Sure. Well, the premise being that considering that post-financial crisis with zero rates, negative rates, and QE, even though we know the Bank of Japan sort of initiated that playbook in years prior, but call that the modern era of central banking. And all these central banks that have done this type of policy have been able to get away with it because the inflation numbers have been low as measured. So it sort of gave them license to just keep on going, and they can lower rates. And if low rates aren't good enough, let's lower rates more. And if lower rates aren't good enough, let's lower rates more. And if our balance sheet's not big enough, let's just enlarge it more. And if that doesn't work, let's enlarge it more. So that's all fine and good for them as long as inflation remains low. But once that begins to change, once the markets actually begin to sniff out a scenario that maybe we are actually beginning to see the early signs of the central bankers getting the inflation that they want, well, I don't want to be a fixed income investor that's going to live through that time period. Right. So unlike 2013 when we had the taper tantrum, that was Fed driven. The Fed said, we're going to stop QE, and the market responded. This time around, the Fed gave no single signals whatsoever about a change in policy.
Well, they're still doing $120 billion a month, aren't they?
That, and they said that they're not raising rates till 2024.
Right.
But the market started to worry about rising inflation pressures. And we've seen that in the goods side, transportation costs, commodity prices. Now we're seeing it spill over into services. And that's why we've seen a rather dramatic rise in inflation expectations in the TIPS market, and a bond market that, outside of the Fed's manipulation on the short end, saying, you know what, we're going our own way. Right. And that you may not want to raise rates for years. You may still want to do your QE every month, but we're worried about the inflation story changing, and we are going to adjust rates for you. And that's what we've seen. And it's been a global phenomenon. Now, less so in Japan because they have the yield curve control, less so in Europe because the amount of QE so overwhelms the amount of net issuance. But in Australia and the US, where the QE is a smaller portion of the net issuance, they've lost control in the long end relative to where they want rates to be.
Yeah. And what's also interesting, too, our good friend Lynn Alden has pointed out many times that the M2 money supply in the U.S. went up by 25%, compared to Japan, as an example, by 10% in 2020. So that would make sense why the rates are going up even more at the long end of the curve, maybe some more inflation expectations when you have the amount of currency units increasing by 25%. I know 10% is a lot, but it's there's a 15% delta there.
Right, and also down on the ground level of real life inflation pressures. I mentioned commodity prices and also on the goods side, but transportation as well. And supply chains have been turned upside down in COVID, and they are not easily repaired and fixed. And now we're seeing a shortage of semiconductors, and then auto industry plants are having to shut down because they can't get their semis. Every single company that makes something that then gets transported is feeling big inflationary pressures. The question is to what extent does it spill over into other areas of services outside of transportation, particularly rents, since rents make up a big chunk of CPI and less so on PCE in terms of bringing together both goods and services inflation. Because for years pre-COVID, services inflation was pretty persistent, running within CPI 3% per year. A lot of that medical care costs and rents. And there's always been this downward pressure on goods, which There typically always is, as technological advancements bring more production efficiency, you lower the price of producing products, and you get this goods deflation. Now you have goods inflation. You've seen a slowdown in services inflation because of COVID and rents, but now I think you're going to start to see an inflection higher in rents because of the dramatic increase we've seen in home prices. So CPI is not measuring home prices,
Right.
but owner's equivalent rent will at some point follow the rise in home prices, as it has for the last 15 years. The change in home prices has led owner's equivalent rent. So now you have 10% increases in home prices, you're going to start to see an inflection higher owner's equivalent rent. If goods prices still remain sticky because supply chains are not repaired and so on, and commodity prices still remain elevated, which I think they will and will go higher, then you have a combination of services and goods inflation that I think at least the tips market's beginning to sniff out. And
Right.
I think that's going to mug these central bankers with that reality.
So a couple questions there. Where do you see the official CPI print in, let's say, a year? I think it just came out the other day. It was like 1.7. Do you see it getting up to 3 or 4, or how high? And then the other question would be, how does that affect the long end of the curve? And at what point does the long end of the curve really start to affect not only the stock market, but the real economy?
Well, just through easy comparisons in the next couple of months, it'll get into the 2s. The question is what happens when those easy comparisons sort of go away? That we won't know until really June, July, August. But I think June, July, August, you're going to be seeing 0.3, month over month, and that you're going to see, even after the easy comparisons, potentially 3% inflation numbers. But within PCE, which is the other metric that the Fed likes to focus on more, even if it goes to 2.5, 2.6, you're talking 20 to 30-year highs in that PCE figure. Mm-hmm. So even though these aren't high rates of inflation, they're higher rates of inflation in the context of interest rates that are still low. Now, to the question of what level of rates matters for the market, well, it's clearly mattered for technology. We had a 10% correction in the Nasdaq that was solely attributed to the rise in interest rates. So we've already crossed that line. It's a question of whether the market gets accustomed to the new level of rates and we sort of consolidate here, which is possible, but rates are still going higher. And I always like to say that valuations don't matter until they do. It's very easy. If you're going to pay 25 times earnings for something, well, why not pay 30 or 35 or 40 times if interest rates are very low? Valuations don't matter on the upside. But when interest rate regime changes, when rates go up to a certain point, well, then valuations begin to matter and investors become more discriminating. Now, on the flip side, with value and commodity stocks will go where the commodity prices go. Value stocks that are trading at 10, 12 earnings, 10 to 12 times earnings, well, you get a rise in rates. Well, what are you going to knock it really down? It's already so low already. But if that company is all of a sudden going to benefit from an improving economy, then investors won't care about a cheap valuation and won't penalize it as they would for a stock trading at 30 times, 40 times earnings, or let alone sales, which we've obviously seen with companies paying that kind of premium. And then you throw in the frothy areas of the market like SPACs. Well, a change in interest rates changes investor attitudes towards a variety of risk taking and valuation. So it's more than just one sector of tech that could be impacted by this rise in rates, which I think will likely continue. Now we've come a long way fast, and we've gotten very oversold in bonds. So I wouldn't be surprised if this 160 is probably the upper end, even though we are slightly above it today. But I think the rise in rates will surprise people on the upside. And then the question gets asked, well, how do central banks deal with it? And we've seen a few different responses. We've seen the Reserve Bank of Australia, which has decided to fight this through increasing QE. Now, they're already doing yield curve control, and this should be a lesson to all of the people that throw out yield curve control as a possible answer here. Yield curve control has failed in Australia. They went their yield curve control out to 3 years is 0.1%. 0.1, that's it. But you know where the 5-year Australian yield is? 0.85. More
really
than
steep fast
over the last couple months. Where's their 10-year? 170. Got as high as 190. That's with yield curve control. How's yield curve control worked in Japan? Now they've gone out 10 years. yeah, they've been able to maintain the 10-year yield within a pretty tight band of 20 basis points above and beyond zero. But what's the result? Well, they basically killed off their entire regional banking system.
Right.
So yield curve control is a very dangerous way to go. Now, I know people are going to say, well, the U.S. did it in the 40s and 50s,
Right.
and well, yeah, I maybe they'll try, but it was a difficult inflationary situation, and we saw a big spike in interest rates after they got out of it. So it's not necessarily the right way to go. Then you have the ECB. So here, well, first of all, here you have central bankers that want higher inflation.
Right.
Well, usually when you get higher inflation, you get higher interest rates. Well, now that they're getting the higher interest rates, now they are losing their mind. Then I ask, well, why are you rooting for higher inflation then? So the ECB has decided to fight back. Yesterday they announced they're not changing the overall total package in euros of QE, but they're speeding it up in order to suppress and tamp down this recent rise in rates. So the German 10-year is still negative, but because it's less negative, the ECB is in a tizzy here. So it's really just it's really insanity, but that's what they chose to do. And then, you know, we'll see what Powell says next week. I mean, the early commentary from central bankers within the Fed, they've sort of welcomed this rise in long rates because they're saying, well, it means that the market's sniffing out a better economy. But at some point, they will likely respond, even though they also want higher inflation. Well, if you're going to want higher inflation, you got to accept higher interest rates. But they won't respond really until something breaks. And
I mean, they just want negative real rates. That's the whole thing, isn't it?
Right. That's what all central bankers love. And but the Fed's not going to really do anything in terms of altering their QE program or Operation Twist or even yield curve control until things break. And when I say break, I'm talking about credit markets that get unhinged, spreads that widen out, stock market that falls sharply, housing that maybe gets impacted. We're not there yet. So I think that they're going to be somewhat nonchalant next week, and maybe, I don't want to say dismissive, but I think that they're going to hope that things calm down.
Yeah.
Rather than take the stance of the other central bankers and try to fight the market. Because if you fight the market, you will likely lose unless you want to be the Bank of Japan and basically own the JGB market. I don't think the Fed wants to be put into that position.